Alright guys, it's been a long time since we've hit up any discussion of the market, so I want to get into that. I want to talk about the Dow Jones Industrial Average and the S&P 500. Let's talk about the S&P 500. They're basically the same thing, but we'll look at the wider benchmark index here. I'm very concerned right now at this level. If you are somebody who is bullish on blue chip equities, you got to be concerned because we've had a lot of big upside momentum. You know, especially here when we had the Brexit, we saw the markets worldwide just sort of collapse, you know, have a flash crash. And then almost immediately we had a flash recovery. And from that flash recovery, we see the markets just boom, they just jump higher. And for what? You know, this jump, this rally occurred on fundamentally, a fundamental lack of news. And then once it did that jump, it kind of, you know, traded sideways. And then all of a sudden at the tail end of that sideways channel, we get news that, hey, Janet Yellen's feeling pretty good about the economy. And the rest of the central bankers, a consensus of central bankers also feel good about the economy. They like some of the key economic metrics that have been produced. So why not raise interest rates? You know, the interest rates are near multi-year record lows, actually near historical record lows. So let's start raising that rate. I mean, let's chip off some of this speculation here. Well, you know, once that news filtered into Wall Street, well then boom, we see a sudden collapse. And then after that collapse, we did not get that immediate recovery. We didn't get that substantive rise that we saw from the post-Brexit event. No, we've been trading sideways. We've been trading sideways, and from a technical analysis point of view, we've been trading underneath that 50-day moving average. The 50-day moving average, of course, is the short to intermediate length gauge of market strength. So we're trading underneath that. And of course, we're not going to look at the 50-day moving average as some sort of magical, mystical indicator. But what we can tell is that all the Wall Street guys, you know, the professional traders, are also looking at that indicator. And if they're looking at the indicator, you should look at the indicator too, because it kind of gives you an idea of what may happen. Now, because it's trading underneath the 50 DMA, and it's not going anywhere, folks. That's the thing that worries me. It's not going anywhere. So it's just sort of like hanging out. You know, you have this upside move, and now it's sort of like hanging out here, and you have no idea really where it's going to go. Well, given the fact that there's a fundamental lack of news, and also the fact that the Federal Reserve wants to adopt a more hawkish monetary policy, I mean, what else is there but for the markets to naturally correct? I mean, we've seen so much increase in market valuation over the past years based on really not so great news, right? I mean, you know, people talk about the labor market, like, oh, you know, the jobs are coming back. The jobs are coming back nominally. They're not coming back on a substantive basis, meaning that most of these jobs are Walmart jobs, McDonald's jobs. They're not jobs that you can base a career on. And you can tell that by the fact that the liberal mainstream media always says that we haven't seen wage increases, that wage growth has been stagnant. Well, if people are getting really great career type of jobs, then there's no way that wage growth will be stagnant. It's got to move up, and it's got to move up in a pretty big way, in a pretty big magnitude, if indeed those jobs that we had gained on these positive labor reports are actually quality jobs. They're not quality jobs. They're Walmart jobs. They're McDonald's jobs. That's why the media always complains wage growth is stagnant. So you have fundamentally poor news, and in this particular case right now, you have a fundamental lack of news. Let's say though that the risk, that you're still very bullish. Okay, so think in your mind, if you're bullish, and I'm not here to give recommendations. I'm not making any recommendations whatsoever. I'm just, playing a little devil's advocate here, okay? If you are bullish, I mean, what would be the upside target? I mean, are you looking at, 2,200 points on the S&P 500? Or maybe you're looking at, 2,250, 2,300 points on the S&P 500? I mean, that's not really that big of a gain from from where we stand. Right now we're looking at a little over 2,100 points, so it's not that big of a gain. So you're going to risk, like a handful of percentage points over the downside risk, which is tremendous. I mean, you can look at the downside risk as a tangible target at the 200-day moving average, which is the longer term gauge of strength, and that stands at a little over 2,000 points. Okay, that's a pretty big drop. But I see over here on this on the charts that it looks like we're looking at a broadening wedge pattern in mid development, and a broadening wedge pattern, whether it ends up being bullish or bearish long term, that in the intermediate term, that the broadening wedge implies massive volatility. And right now if indeed we're looking at a broadening wedge, we're looking at the charts right now as being very bearish, because we're looking at the development point where the markets in that pattern would actually sharply decline. If I'm just eyeballing this, I mean, we could be looking at somewhere at 1,900 points, 1,925, 1,930. I mean, that's a huge drop. That's a huge drop from where we are at 2,100 points. So you're taking, by being bullish on the equities right now, and being very bullish on it, you're saying that you're gonna look at an upside of 3, 4, 5%, and you're going to risk downside of 10% or more. That's a pretty substantive risk for not so much reward. I'm not sure if I want to do that. I'm not sure if I want to have a risk to reward ratio of 2 to 1, 3 to 1, 4 to 1. I don't know if I want that. I mean, I don't know if anybody would want to have that kind of risk to reward ratio. So my assumption, my gut reaction to this chart, we're not going to dive into every single economic metric, but just looking at this chart, I mean, to me, and I think this is broadly the logical choice, why wouldn't you want to be careful? Or why wouldn't you want to just, sell some of your positions here when it's, at a very, very high level, when it's at close to record highs, very close to you're very close to all-time record highs. Why wouldn't you want to, take some of that money, take some of that profit, put it in the bag, and then, if the markets go higher, all right, I mean, but they'll probably move higher by a very small margin. But if I'm right, look, you're saving yourself a lot of pain and a lot of losses. I mean, you're easily saving yourself double-digit losses if indeed this is a broadening wedge pattern, and if indeed we are going to suffer that massive correction that I believe we are in. I mean, if this is a broadening wedge, this looks like this is the mid-development point, the mid-cycle of that pattern. And the mid-cycle of that pattern, that's not good if you're long the markets, okay? So I just think, why not be cautious? Just, why not be a little bit more vigilant at this point? I'm not saying to short the markets or do anything crazy, okay? I'm just presenting some information, presenting some thoughts to you. And I gotta say, right now this looks like an opportune time to take some of that money home, actualize those profits, and then let's wait it out. I mean, again, we're also in a very volatile election year. You don't know how things are going to work out in the markets, how the markets will react. Okay, I believe that Donald Trump is going to win this thing. But how will the markets react to a Trump presidency? Or the likelihood of a Trump presidency? I mean, you know, there's a lot of variables. Lots of variables, very little reward potential, and a lot of risk. To me, when I look at this chart, when I consider the fundamentals, this is a no-brainer. You really want to be careful at this juncture.